C'est bon, nous sommes live.
Okay, great. Hello, everyone, and welcome to this webinar on Banking Crisis Management Program in response to COVID-19. I hope you're all keeping safe and well in these uncertain times. My name is Abdul Qadir Ben Brahim, and I'm the Program Coordinator for the Making Finance Work for Africa Partnership. We're very pleased to be hosting this webinar with the London Institute of Banking Finance. So for those of you who don't know, the London Institute of Banking Finance is one of the oldest training and professional body for banking and financial services in the UK, providing thought leadership and financial education. So we're very glad to have them on board and talk about their latest program on banks crisis management, which was really designed in response to the COVID-19 crisis in banks around the world. I won't say any more, as I'm sure our speakers will give us a good overview of the program. I believe we have a very good mix of representatives from African central banks, international and local banks, development finance institutions, as well as multilaterals and other industry practitioners. So hopefully from this session on banking crisis, you'll benefit greatly from the learnings and the knowledge that will be presented today. For today's session, I'll quickly run through the agenda. So first of all, I will go through some housekeeping items, and then I'll follow that up with a brief presentation on making finance work for Africa. I will then introduce you to our panelists and give the floor to our speakers for their presentation. We will then move to a Q&A session, and then I will come back at the end and provide some concluding remarks. So for the housekeeping items, please keep in mind that all microphones are muted automatically. And this is just to ensure the highest quality experience throughout the webinar. You can submit your questions using the chat box feature or the Q&A feature. And if I look on my screen, you can find those in the bottom right side. We also invite you to submit your questions anytime during the webinar. So please do so as the session is coming along, and we'll make sure to address them during the Q&A session. Also, to ensure that the question is seen by the moderator, please make sure to select all participants from the drop-down menu when you're submitting your questions. We have a little more than 200 or so people registered for this webinar, so there is quite some, we're seeing a lot of interest, and we may not be able to answer all your questions. But please do know that we'll make sure to share the panelists' contact information at the end, and also our contact information, and we'll make sure that any questions that remains unanswered will be addressed. Of course, the webinar recording and presentation will be available on our website, mfw4a.org, and we will also email it to all participants and registrants along with the presentation. And finally, please, I would like to ask you to just take a few minutes at the end of this webinar to fill a survey. This survey will appear as a pop-up once the webinar is over. Okay, so first I'd like to start off by sharing just a little bit of background on making finance work for Africa. So we are a G8 initiative launched back in 2007. And when we were really first established, we drew attention to the opportunities and challenges of financial sector development in the wake of the financial crisis in 2008. Of course, now we find ourselves in what is likely to be a far deeper and probably longer crisis than that of 2008. But I mean, throughout our existence, we operated under the belief that financial sector development requires strengthened collaboration among all stakeholders. And so multi-stakeholder coordination, knowledge management, and advocacy is really at the heart of making finance work for Africa's mission. A secretariat supports the partnership's mission, and we are hosted at the African Development Bank in Abidjan, Côte d'Ivoire. So in addition to the African Development Bank, we're also supported by various different donors, their logos, which appear on the upper right corner of the screen. So if we go to the next slide, just talk a little bit about our activities. They are broadly focused on three thematic pillars. So financial inclusion, long-term finance, and financial stability and governance. And as you see in your screen, each pillar covers different work streams. Of course, knowledge management and advocacy is a cross-cutting pillar that is sort of integrated throughout our work. Okay, and then of course, finally, you can see the different logos of our members. As I mentioned earlier, we're funded by the African Development Bank, but also GIZ, Agence Française de Développement, European Investment Bank, the Ministry of Netherlands, Afrexim Bank, and the European Commission. All right, so I will stop there now, and I will turn to our speakers who will speak to us about the bank's crisis management program and share some experiences and learnings that we can really take away from this crisis. So we are very honored to have with us today Emmanuel Rondeau, who is a visiting professor at the London Institute of Banking and Finance. Moderating this session will be Jesus Fernandez Munoz, who is a trainer and program co-leader at the London Institute of Banking and Finance. I believe Jesus will be moderating the Q&A session. And then I'll then come back before we wrap up with my concluding remarks. So, gentlemen, over to you.
Thank you very much, Stefan, and good afternoon, everyone, or good morning, depending on which time zone you are. My name is Jesus Fernandez, so I'm the program co-manager for the Crisis Management for Banks program that we've conceived in response to the COVID-19 crisis. This is a program that we're currently running in Tunisia with the Ministry of Finance for the teams that manage the equity stakes on the state-owned banks and the non-executive directors appointed by the state to the boards of those banks. So it's a module where we try to deliver different technical elements linked to the crisis. And this is a little bit of an introductory session that covers the different topics. In addition to these technical topics, in our work with the Ministry of Finance in Tunisia, we deliver a number of coaching sessions on soft skills and other technical topics with the idea of helping them think through their own issues. We do this with 2 local institutes so that we combine international best practice with good knowledge of the local context. And with Emmanuel now, we're going to cover the different topics that will go through the program. So we can go to the next slide, please. Thank you. So, Emmanuel, some people say this crisis is just one crisis after another, and there is not so much specific about it. However, other people claim that this is a crisis that will change the world, that the planet will not be the same after the COVID-19 crisis. In your opinion, and as far as banking is concerned, what is your view after the COVID-19 crisis? From the banking industry perspective, what makes this crisis different?
Thank you, Jesus, and good afternoon, everyone. Indeed, we could say that our job in banking is really to manage crisis, and it's just one crisis after the other. It's always unexpected. This one is clearly unexpected, but all the previous crises have been unexpected too, whatever the trigger, being a political event or being, of course, the 2008 financial crisis based on the RMBS. There is always an element of unexpected trigger, the unexpected triggering the crisis. So and I think banks are now well used to manage this kind of situation. So in a sense, it's true that some people just say it's one crisis after the other. We also recognize that this one is still developing. We have no certainty yet on the crisis. The situation is far from being stabilized, and we will certainly not comment on what could come up now. Different situations between the various regions. even this, what is interesting is that it's a worldwide crisis, which is impacting most of the regions. And in that respect, it's certainly a crisis where we can share experience much more than in previous time. And that is very interesting. We have seen that with the program in Tunisia, where basically we exchange views on what's going on in Europe, what's going on in the UK, what's going on in Tunisia, and working with our local partners, we can really try to figure out the best reaction to the crisis. I would say that here, what is maybe the most striking for this one is that, as opposed certainly to the 2008, which is a big reference, of course, for bankers and the financial world, is that we are now talking about a crisis which has been triggered by health issues, and health issues impacted the economy, and the economy then turned into financial problems. And in that respect, I think what we very much try to build upon with all our banking partners is that here banks are not part of the problem; they are part of the solution. It's a crisis where we have seen a level of cooperation between all partners, which is definitely much more important than in the past. And what we have seen is that banks are very much involved in trying to help and support. So that is maybe what makes it different from the previous ones, and it's an opportunity in that respect for the banking industry.
Okay, thank you, Manuel. So we've now been more or less 4 months through the crisis. Some regions are doing a little bit better than others from a health point of view, and therefore banks are focusing on the economic slowdown more much than on the lockdown that they had to focus at the beginning. So in this context, what are the lessons learned from a governance perspective? How effective do you think have banks been in managing the crisis, and have they done better or worse than in the past?
Well, it's clear that there have been lessons learned from the past, and that's good. That's good. Governance has been tested. We have seen the rollout of business continuity plans and crisis management plans. As I was saying earlier, it's now banks. And in that respect, it's a positive point that we have seen banks entering into this crisis much better prepared than in previous ones. And the improvement of the preparation in terms of BCPs and crisis management has been clearly shown. Also, we have seen a good level of cooperation and coordination between the public and the private sector. That's something which has been, to an extent, almost never seen before. And that's a very positive point. Public and private have really worked hand in hand, and it doesn't mean that there's not been any issue, and clearly the share of the burden is still to be discussed. But the cooperation in itself and the way that it has been rolled out is quite good. So in terms of governance for banks, I would say that maybe one of the most important items we really developed through the program is to see how, through the crisis, banks' boards have maintained a good level of discipline. Not just the discipline about information, communication, the committee procedures, the way indicators are escalated and tracked, but also the main item, which is very much a difference between the executive role and the supervisory role at the board level, and that is something very important, because the executive of the banks have been really focusing on the day-to-day operations with a number of new challenges to deal with. And it's important that the board keep a broader view, a longer perspective. And that's where I think board have a specific role to play, sticking to this supervisory role. That is a critical aspect in the global rules as set by the Basel Committee in terms of governance for banks. And that is something that is certainly a topic we want to discuss and investigate more with the local partners when we run this program, because it's something that maybe is more sensitive and not always easy to deal with.
Okay, no, thank you. That's great. If we now turn to risk management, Emmanuel, and how banks across the globe have faced the crisis, what is your view? Maybe you can also share your own experience in given what you say in this area. What are the areas of risk management that the program will focus on?
Yes, well, and indeed, as part of my trainer's background, I mean, I'm also a board member today, and I share the board risk committee of a large French bank. So I have been involved in sort of daily discussions about that. So it's also sharing my own experience with, as we have done in Tunisia, discussing with non-executive directors of state-owned banks, and very useful sessions to run this program and exchange views and experience. So it's clear that well, we in the period we are going through, of course, all the dimensions of risk are on the table. Financial risk and non-financial risk, and we have seen here that non-financial risk take a massive importance. And there is this importance of reading across all the risk categories, making sure that there is no blind spot, which is normally the main issue when you face a crisis, that you just cannot concentrate on every single item of your portfolio of risk. And that's also where you see that some banks are well prepared, are well equipped, have good risk appetite framework, and you can use all these tools, which are reasonably new in the banking industry. They have really been developed over the past few years, and it's something that has clearly strengthened the way banks have been able to answer to the crisis. I would say there are maybe two points I would like to focus on. The first one is people. This crisis is very much about people. It's about making sure that our people are safe and secure. Health is the key, the critical aspect of this crisis, and of course, it means first of all for banks the safety and security of all our people, and in particular the security, making sure that the risk management team is protected, because all the people you need, in fact, not just them, but all the people you need. So that's a very important aspect, and making sure you allocate properly your resources through the crisis, because you have reduced resources. Some people are impacted, some of your employees are impacted, and you have to allocate your resources. I think it's also a good test of all the tools, all the new tools that are now in place in terms of the risk appetite framework, and the way the board can monitor the risk profile of the bank. And there are a lot of lessons that can be learned from these tools. So some of them are very effective, others are not really effective. And that's what this crisis is telling us about. So it's good to compare and contrast. That's what we are doing in this in the module on risk review. How you use the tools that are now in place in banks, and how effective they are when you are in the middle of the crisis.
Yeah, so if I hear you correctly, you say the focus has been very much on non-financial risk for this COVID-19 crisis. Do you think we've tested the limits of operational resilience? And does it mean that we should be better prepared for future crises?
Well, definitely we have tested some limits, because when you are talking about getting all your branches closed, or and the problem, the conflict between the need to service clients and to keep your network open, at the same time, the problem of protecting your employees from the disease itself, it's something that has really tested the limits of operational resilience. And I think the feedback broadly across the globe is really positive. on the way everywhere banks have been able to deliver. I like to insist on that. Well, we have tested the BCP to a new extent, and it's very important, especially from a board perspective, to understand what has worked well and what has not worked so well, to be able to, again, to prepare for the next crisis, because this one is just a crisis along the road, and there will be other ones with new dimensions. And it's always, we need always to take lessons from what we are experiencing, and specifically in terms of operational resilience. It's interesting because if you look at the indicators that a board is usually considering, they are largely only financial indicators on the financial performance of the firm. Some commercial indicators, but the consensus is that there are a limited number of operational performance indicators that are really tracked by the board. And through this crisis, the most important was to track operational resilience performance. And in that respect, it means we suddenly had to put in place or to track new indicators which were very much related to the performance of the network, the performance of the transaction services, and which are usually a little bit ignored by the board, and that is a rebalancing of the priorities towards more aspect of operational risk. I would say that it's important. It's a good time to discuss precisely what should be the best risk indicators or performance indicators to have in place through the crisis, and not just the sort of business as usual indicators, which have proven not to be really relevant when going through this specific crisis.
Yes, no, it's certainly important. So we've seen how banks have been focusing on protecting their employees and clients, and while trying to ensure the continuity of their operations, having to migrate and customers to electronic channels and others, given limited or no access to the branch network. So in this scenario, do you think that compliance has been put on hold? No longer hasn't been a priority for the banks?
Oh, no, not at all. Well, in fact, it might have been a temptation for banks. We all know that the agenda on compliance is very heavy, and through all the dimension of compliance, being client protection, anti-money laundering, and terrorism financing, the fight against corruption, internal and external fraud. So the agenda is very, very heavy for every financial institution in the world today. And the initial temptation might have been to put a little bit all that on the back burner because of the priorities. The priority was just to make sure that the whole system was up and running. The reality is that, and that is typically something the board has to act upon. The reality is that there is no time for complacency at all, even through the crisis, for all these topics. And that's typically a topic where I think the executives might be a little bit willing to release the pressure on their teams. And it's on the contrary a time when the board must insist that we stick to the agenda. The reason is twofold. The first one is that I mean, there is no reason why we shouldn't fight corruption, being the crisis or not. For instance, just to take one example, and it's very important to keep the highest standards in that respect of compliance. So it's a whole journey the whole financial world is embarked upon, and now we need to stick to this journey and to make the progress we are supposed to deliver. But the second reason, which is I think even more interesting, is that one of the consequence of the crisis has been the massive jump in the fraud events. It's a known pattern that when there is a crisis, fraud is increasing. And that's true. That's very true for the banking industry. And it's specifically true this time. It has been true, and it's still evolving for hacking. And banks are the attacks on banks from hackers have increased to unknown rates. I mean, that's something we have shared with many banks. So it's not just to stick to the agenda. I would say it's also to protect the bank at a time when they are more vulnerable. And this is something we work through the program to go through the various dimensions of compliance and see how, despite the crisis, despite the other priorities, we can still focus on compliance and make sure we don't increase our vulnerability.
Yeah, this is certainly key, as it is liquidity management throughout the crisis. I think there's a consensus that central banks have been very strong in their reaction to the crisis. They have provided large amounts of liquidity. But how effective do you think that they've been in pushing this liquidity down to the banks? And do you have any other comments that you would like to make on this critical aspect of crisis management?
Yes, I think that there is you're right, a consensus that central banks have been very quick to react on the crisis, to provide liquidity to the market very extensively to make sure that there was no liquidity crisis, and also to reassure the markets. We have seen what happened in 2008 when suddenly the market was frozen. And there has also been the experience of 2011 with the sovereign debt crisis in Europe. So I think central banks have reacted very effectively, very quickly, in a very coordinated way, and that's very positive. What we try to insist upon through the program is more about what banks should do, because we have to be careful that because the central banks have really, and not just central banks, but central banks and governments have very much taken the lead in fighting the crisis, and they have imposed a number of things, of rules, and so there might be a temptation for banks to basically consider that liquidity is not with them. It's not their problem. It's the problem of the central bank. And in fact, the situation, as we all know, is very different from one country to the other, depending on the maturity of financial markets and how is organized the liquidity in the country. But what is important, I think, for all banks is to have their own liquidity risk management in place, in order. And we know from experience that everywhere, it's very far from being the case today. It's still a very mixed situation. Some banks and some countries are more advanced than others. But there are still a number of critical elements in liquidity risk management which have to be developed. And I think what this crisis is bringing is a good opportunity to sort of self-assess within each bank where are the strengths and what was properly in place in terms of liquidity risk management and what was missing. And we really encourage through this program bank boards to look at this and to take advantage of this crisis to draw a number of lessons about the liquidity adequacy assessment process, and that is something that I think will bear fruits for banks again in order to prepare for the next crisis.
All right. So, Emmanuel, we're now in early July, and soon we're going to start seeing the first half results for the banks. How do you think the loan books will look like? And particularly as countries continue to implement IFRS 9. So what should be the impact of the crisis on the loan books?
Well, I have no crystal ball, but when you read at the papers from the rating agencies, they are quite frightening, and their expectations in terms of the deterioration of the PD levels, the probability of default levels, is quite huge. Also depending on various scenarios, so it can basically double depending on the scenario, between the base case scenario and the worst case scenario. So it's too early to say. It's too early to know. All the more as well, there are now some regions in the world where the pandemic is picking up again. So the impact on the economy will be massive. The impact on the loan books will be massive, and we don't know yet to which extent. It will be interesting to track results for H1. We have seen for the retail credit portfolio the action taken, the moratorium, forbearance, suspension of payments, which have helped creditors not to support their clients, the debtors, and it's very important to highlight how much banks have supported their clients, encouraged by by governments and local policies. If we move to the next slide, we can also see that for the corporate loan portfolios, we had an extensive support brought by we mentioned here the French and the British examples, but in many countries there has been support brought to corporates through a moratorium on amortization schedules and so. What is maybe the main topic of the day in that respect is the impact of the new accounting rules, IFRS 9. IFRS 9 was very much to anticipate the deterioration of loan portfolio, and as you all know, to increase the provisioning before the crisis, to avoid a sort of cyclical aspect of and cyclical acceleration of provisioning at a time of crisis. In fact, as we are just introducing now IFRS 9 in a number of countries, it has a sort of an unexpected impact, and that's something we really talk about through the module. Because it's interesting. Some countries have already turned into IFRS 9, so there is a degree of experience and about it. Some countries are considering moving into IFRS 9 application. And it's very important, very interesting to debate the impact of IFRS 9 at the present time. As most of you have seen, there are a number of comments which have been made by the supervisory body on the application of IFRS 9 to make sure that it had not a detrimental impact on banks and basically restricting banks from lending. So it's at the heart of this topic, very much on the whole issue of provisioning and on the loan books. But the impact will be definitely massive.
Yeah, so certainly we see the provisioning levels going up, and therefore that's going to have an impact on the bank's results and ultimately on the capital ratios. So how will you cover the prudential impact of the crisis during the program?
This is very much the end result. We have seen that because of everything we have discussed up to now, being the business losses, the sharp decline in the business, the top line of banks, the losses on the credit portfolio, and the increase in the cost of risk, as well as the value adjustment for financial assets, which again is harming very strongly banks' balance sheet and their capital. All this will end result into a significant impact in terms of prudential capital. It has been interesting to see how the central banks in Europe have tried to protect the banking industry, and they have proposed to limit the regulation, or to waive the regulation for some time. You have seen that typically in Europe as well as in the UK, the capital buffers have been released, which is exactly what they're supposed to be used to at the time of crisis, using capital buffers to weather the stormy weather. So that's very much what we are going through. But it's clear that at the end of the year, the impact on the bank solvency profile will be quite significant. The good news that there is a consensus again here that banks have entered this crisis much better prepared than in the past, thanks to the regulatory framework and all the solvency regulation, all the regulation about liquidity, capital, have helped significantly to strengthen the bank's capital and to make them much better prepared when they entered into this crisis. So now it's a question of following up, and that's of course one of the critical topic for the board, because it has a direct implication for dividends. And you have seen that a number of central banks or governments have asked their banks not to pay any dividend, to suspend dividend for at least for this year, 2020. So globally, there is a sense that banks are much better prepared, and that the situation is far better than maybe in the past. But it's obviously a critical topic for the board, because that's what will impact the most significantly shareholders of the banks, being public or private shareholders.
Yeah, thank you very much, Manuel. I think you've provided a very good overview. You've very much insisted that we're still going through the crisis, and it's a little bit early to draw conclusions. But are there any thoughts that you can share, or some key takeaways at this stage?
Yeah, it's very early, and I would certainly not draw any conclusion. But even if the title of the slide is conclusions, I think these are just maybe a few points to food for thought. I would say, more than conclusion. First of all, this crisis is a very humbling experience, and as any crisis is, and we have to be very cautious in the way we look at it, and the way we draw lessons. The good news, in a sense, that for the first time ever, I think health aspects have prevailed over economic impact for across the globe, which from a, I would say, just a people perspective is a good news. But and we know that it's a massive challenge, massive human challenge first, to deal with this crisis. But at the same time, it's clear that the economy will be more massively impacted, and banks have a central role to play here. I come back to my first point, introductory point, about the fact that this crisis is an opportunity for banks to restore trust and confidence with their clients, because they are part of the solution and they bring solutions to clients to a more massive scale than ever. And that should be beneficial for an industry which has always been very poorly considered, and all the more over the past decades because of the 2008 crisis. So it's really as in any crisis, there are many lessons to be learned. I think that's where the board has to be quite active, proactive, because it's from the crisis that the main lessons can be learned in terms of how well the bank is equipped, how well it is managed through the crisis, and more importantly, what are the key deficiencies? Because these are the areas which, properly identified and worked upon, will help build a stronger institution for the future. So it's really a time of opportunity in that respect, both internal and external. Internal opportunity to identify the main weaknesses the banks have to still work on, and external to restore trust and confidence into this industry.
Thank you very much. And we would like now to open the floor to questions.
So do we have any question coming through?
The question will be taken from the Q&A part. So if you look at the bottom right, you should see some question that has been typed in, and feel free to read them and also respond to them.
Okay, so we have a question on what is the importance of digital financial inclusion in handling the COVID-19 crisis in banks, Emmanuel?
Sorry, could you just come back to your question? I was trying to access them directly, but it's better if I take your.
Yeah, sorry. So the question that we have is on what is the importance of digital financial inclusion in handling the COVID-19 crisis in the bank?
Yeah, so it's a very good question and a critical question, because it's something that I think everyone has realized, which is the importance of digitalization as an answer to this kind of crisis, through the two sides, internal and external. Internal, making sure that people were able to work from home, and it has been the case that for most of the banks, you have rates of sort of, and in Europe, you have rates like 90%, 95% of the personnel being able to work from home. Very significant ratios, and including some activities which the regulators have approved as being dealt from home on a temporary basis, of course. But typically, some traders have been able to trade from home, which, as you know, from all the regulatory framework, is quite a move. So internally, it has been clearly seen as one of the critical factors, and externally to deliver services to clients. We know that through Africa, as is the case through Europe, by the way, because some countries are much more advanced than others. It's a very contrasted situation depending on the countries and how developed digitization is, and all communication infrastructure which is needed. But definitely the main conclusion on this topic from the crisis is an acceleration of the digitalization. The problem which goes with that is the disponibility of resources, because now, I mean, everybody wants to accelerate, and the resource is limited. The capacities, the technicalities, the technical expertise is, and which means that the costs are increasing. So there is a need, there is a global trend, and it will not. The crisis will just accelerate this trend, which was already existing, but which is now clearly accelerated because of the crisis.
Yeah, and I think if I can add to that, Emmanuel, I think in Africa there's a very high penetration of mobile money, and this has been more important throughout the crisis because that has avoided the physical handling of banknotes and coins, with the consequences that could have from a health point of view. Obviously, as you were saying, there's a bit of a divide. It's very important that to have access to mobile money, first you have a telephone network that you can rely on. So expanding the network and the physical infrastructure, it's key in providing that financial inclusion to support the further development of mobile money throughout the region and globally. Okay. And also to provide financial education to the users of the digital financial channels. So moving to another questions, what would you say are the main differences between the different countries that you've looked at in terms of the impact of COVID-19?
It's difficult to say because in fact, all regions in the world have been impacted. Mm-hmm. And we are well aware that it's very difficult to extrapolate what we have experienced in Europe and in the UK to different regions, and of course including the various regions of Africa. That's why through our program we always team up with local partners to make it relevant. We don't just come to a country and deliver a program. We team up with a local partner and we roll out the program together to be able to understand the local specificities and to adjust to the local specificities. What we have seen is that the measures taken have been almost the same everywhere in terms of supporting the economy, in terms of moratorium, in terms of liquidity brought by central bank. So it's interesting to see that through across the globe, the answers have been very similar. Then I would say maybe the devil is in the details, and there are many differences from the legal context of every single country, and how the central bank can manage the situation. So there are still a lot of differences, practical differences, but globally, I think most countries have acted in the same way, which is to have a more accommodative monetary policy to ensure liquidity, to make sure that there is no run on banks, and at the same time help the corporates and the individuals with their treasury, with their liquidity, and that has been quite consistent across the globe.
Thank you, Emmanuel. You've touched upon the suspension of dividends as a necessary measure to preserve capital, but do you think there's a flip side to that? Could investor confidence be adversely affected by the suspension of dividend payments, in your opinion?
It's difficult to say. At the same time, it's easier because it's a sort of standard measure imposed by the central bank, and just as a reminder, you know that for instance, all of the European countries are now under one single monetary supervision from the European Central Bank. So it's much easier when you have just sort of coordinated and harmonized approach as opposed to different situation across the border, which then create competitive pressures and so on. So here, I think it's a one-off that people will understand because of it has been imposed. The problem will be much more how it's dealt with in the future, and because there is a sense that there will the way out will be different from one country to the other, and that's where there will be tensions. It has to be on a sort of harmonized an harmonized approach, and if not, of course, the places where there will be more restrictions will be could be potentially earmarked negatively by investors.
Yes, certainly. Based on your experience in delivering this program, what do you think the main benefits are for the participants and for the different countries that take part of the program?
Well, our experience in Tunisia is extremely positive. We are dealing with the teams of the Ministry of Finance as well as with non-executive directors of the state-owned banks, and I think it's very constructive in the sense that we are really going through the details of all the items we have very briefly touched upon through this presentation through dedicated sessions, and basically there are so many questions being asked and being discussed that it's an acceleration of the learning for everyone, I think. What is also interesting is that for once it puts everyone around the table. And here I'm talking more about the non-executive directors for all the banks. They are all joined into the same forum, the same seminar, and it's very useful for them because they can exchange views. They are in the middle of the crisis, and we are sort of neutral place where all together we can discuss the many different issues, technical problems, views that have to be dealt with, and very openly, very sort of candidly go through these problems, look at the technical aspects of the problem, and without sort of delivering solutions, but really delivering the place where people can discuss and think about the many aspects the many technical aspects that this crisis generate in terms of improving and strengthening the banking sector. So I think that's the most positive, certainly.
Great, thank you, Manuel. We have another couple of questions. In the interest of time, I'm going to read both of them, and perhaps you can give a combined answer. So one of our participants is asking, what are your views on the COVID crisis in Africa, given that it is not so severe when compared to European countries? And we have a second question. What would you say is the most important factor that has helped most jurisdictions avert the banking crisis during this period? Is it liquidity buffer, regulatory response, business continuity plans? Is there a single element that you would like to highlight?
Thank you, Jesus. For the first question, I will not be able to give an answer because our approach is very much about banks through the crisis. So it's about the banking industry, and we are trying to look at all the tools and techniques that are now well in the hands of the banking industry in terms of managing risk, and how all these tools and techniques are tested through the crisis. So it very much then depends on the banks in the respective African countries to explore different type of situations, and So we restrict our approach to the activity of banks, and on a very sort of practical and technical aspect. For the second question, I would say that for me the most striking point is precisely the fact that all these factors have worked together and have been sort of executed in a coordinated way, so that no one alone would have been able to solve the problem. And that is the most striking feature of this crisis, in my opinion. Central banks have been and are absolutely key in terms of ensuring liquidity to the market. With no liquidity, the market is dead, and we all know that, and we would be back to past territories with massive consequences. So liquidity from central banks is key. I think the policies that have been introduced by governments were important because they impose a sort of same playing field level for all participants. Through the crisis, there are a number of rules which are imposed on everyone, and it's important so that there is no distortion in the competition, in the behavior, and it's a health issue first. So it's important that the state is taking the right measures. But at the same time, the regulators have definitely improved the situation of banks when entering into this crisis through all the elements of regulation, from, of course, solvency ratios, prudential ratios, liquidity ratios, but also up to governance, to the importance they have put on the elements of business continuity plans, and so on and so forth. So the whole pressure from the regulators is now proving to be very effective a posteriori, in a sense, and that's very post events. That's very important. And as well, the way banks have done their homework, the way banks have improved their processes, the way banks have strengthened their governance, the way banks have globally significantly improved their risk management process, the way banks have improved their compliance process. So all this is combining into a far better position than what was the case clearly 10 years ago. I don't want to be seen as too maybe positive or optimistic, but definitely I think and this is shared with a number of banks executives and bank board members. Banks have entered this crisis much better prepared and much better equipped than in the past, and it helps. And it's one major player in building up solutions with the central banks and with the governments.
Yeah, no, thank you, Manuel. And I have a favorite quote in this context from Jaime Caruana, who used to be the general manager of the BIS in Switzerland. And this is something that he said in a conference to Latin American bankers in Chile in 2006, 2 years before the 2008 crisis. And he said the biggest risk for banks is nor credits, neither market nor operational risk. The biggest risk for the banks, and all countries have experienced this to an extent or another, is that the bankers don't know what they're doing. And I think in that respect, all the enhancement of the regulation has had that effect of provoking this internal transformation and this preparation of the bankers that you mentioned, that has permitted that the banks are better prepared now than they were in the previous crisis.
That's very true. That's very true.
There are no other questions, and I think we are now 3 minutes past the hour.
Thank you, Jesus, and thank you, Emmanuel. Actually, I wanted to speak right after Emmanuel's presentation, but I didn't realize I was on mute. But I'm glad you figured out the Q&A. Thank you very much. I think I know we started a few minutes late, and there are maybe a couple of questions that came in the Q&A box. Perhaps what I'll try to do is just combine them because we've had quite a few central banks join us. You've already talked, Emmanuel, about obviously the challenges of banking of central bank supervisors, obviously, and what they've done in terms of prudential measures and so forth. The question really is, well, I combine in two in terms of in terms of the monetary policy transmissions of central banks in passing, stimulus policies. How has the bank reacted, for example, to reduced interest rates? And the other follow-up question on that is about the liquidity support that were provided by the central banks. At what point do you think the central banks can pull the brakes on this liquidity injection?
I'm far from being a central banker, so I'm not sure I would have the adequate answers. And anyway, the answer I will make is really from a former bank executive and now a board member for a bank. First of all, on the reduction of interest rates is a clear tool in the end of central bank to create a stimulus, and it's so it has always proved a useful tool, and it's now very well, I would say, mastered by all central banks around the world. And there is always this debate everywhere about is it, and we see that from the Fed discussion in the US as being the maybe the best example. It's there was this debate discussions: should we stop the stimulus or continue the stimulus, and the fight with the politics on that. I would say that for banks there are two things. The first thing is that there is a floor to interest rate. As you know, Europe is experiencing something very strange, which is the negative interest rates, and that is very, very painful for banks in Europe because it directly impacts your top line when rates are so low. I'm not familiar with all the situation in African countries, but clearly I suppose that's rarely the case that there are negative rates, even if it can happen. But it's clearly, I was just referring to this to show the limits of reducing rates, because when you start to enter into well, close to zero territories or even negative territories, then you are really putting a lot of pressure on commercial banks to make a living. So that's certainly a limit to the problem. Then it's true that banks, what commercial banks really need is the liquidity to be able to support the market and to be able to support their customers. As long as this is done in an organized way and I would say, a properly documented way, as is the case now with all the regulation which is in place. So I think we know that this interaction between commercial banks and the way central banks are running their monetary policy is critical for banks, in the sense that they can't do without. But I'm not sure it's and through the crisis it's logical that rates go down because of the bid and ask situation on the market and the support for liquidity. So I think everyone is now quite familiar with this mechanism, where it should stop, and that's really a question for the board of central bank and not for commercial bankers.
Thanks, Emmanuel. And I've got another question here. Is about the pandemic risk was not listed among the risks that financial institutions are typically exposed to. How do you think that regulators at the global level should deal with pandemic risks in the future?
That's very interesting, because if you look at in the history, you know that in the reports from banks, there is always a section on risk, and which has been over the recent years beefed up quite significantly. So now you had 5 and then 10, 15 pages on all the risk the bank was exposed to, which is good, sort of very transparent, being transparent and explaining investors through the annual report and the financial disclosure all the risk that the bank is exposed to. In fact, historically, you will see that if you test back these sections, usually when a bank has experienced a major problem, it was never mentioned before in the risks it was exposed to. So it's something that it's always coming from somewhere else. And I would say that's back to my first comments. This is very much part of being a banker. You never know where the risk will, where eventually the crisis will come from. But I think banks are now better and better equipped with all the risk management tools to face to deal with the crisis. And I think pandemic risk is clearly now high on the list for everyone, and good that it is, because there are some specific answers which have to be brought, but it's just one of the operational risk. What is interesting is that now climate risk is officially introduced into most of the central banks oversight, and the ECB is putting a lot of emphasis on climate risk for banks, specifically for banks. So in that respect, I think there will always be new risks that banks have to cope with, but the important aspect, and that's what we very much insist upon during our program, is how the bank is organized, how is it equipped, what are the tools, what is the governance, to make sure that you can be up to the challenge when the crisis comes.
Yeah, thank you, Manuel.
Thank you very much, Emmanuel and Jesus, really for a very insightful discussion, and also for giving us really a panoramic view of all the considerations of crisis management in the banking sector, covering all areas, from the adequacy of risk appetite tools to the importance of operational resilience indicators, all the way to even the impacts of Prudential impact on the crisis, and of course the loan books. So thank you very much. I mean, we also want to thank also the audience and the for their engagement and their questions, which all just made this discussion very much richer. Just I guess to conclude that here at Making Finance, we'll be working very closer with our partners and stakeholders, particularly in this moment of crisis. As was mentioned before, this is a time to share experiences and to share knowledge around obviously the different areas. And so from our point of view, we'll continue to support obviously financial institutions and the provision of financial services. I think this is a time where many banks need to take important measures, obviously making sure that the business continuity plans are are adequately placed, maintaining client confidence, safeguarding, of course, financial performance, and as is mentioned before, the performance also of liquidity risk management as well. We look forward really to working with the London Institute of Banking and Finance in this particular topic. Also, please stay tuned. There's for next week, there will be a French version of the webinar scheduled. So we should be sending the information on that also very shortly. So again, thank you very much, gentlemen, for this discussion. And hopefully, I mean, we try to answer all of the questions, but if there are any questions that were remained unanswered, please do not hesitate. You have our email contact in front of the screen. Please do not hesitate to send it to us, and we'll make sure to forward it to our speakers. So thank you again, and I wish you all a good rest of the day, good afternoon. Stay safe and stay healthy, and until next time, goodbye.
Thank you very much. Goodbye.